Good morning. My name is Lynn Gillette. I'm the chapter president for the Silicon Valley Chapter of AAII, and we've got a great program today with some real hands-on stock probing that I think you'll all enjoy. Uh, just a couple of housekeeping items. We encourage you to use chat because we have a large enough group that we'd be talking all over each other if we went live. So type your questions into chat and we'll get to them. Stocks you want to talk about, type that in, and any questions that you have. We have a interesting program, but I want to just make a comment that any of you who would like to volunteer for the chapter are welcome to. We have big and little jobs, issues like publicity, finding speakers, maintaining our Facebook page, video editing. You're welcome to come and help, and the help that we get has really been a help in the past. We will let David decide exactly how to handle the questions, but we'll make sure I believe with the size of group and the time that we have, we can get through all your questions today, which a lot of times we can't. Just a note, we have invited other chapters to join us, specifically the San Francisco chapter and the East Michigan chapters. So there'll be members of those chapters joining us. And if any of you want to look at other topics, you can go out and look at what's going on in New York or in Houston or in Portland, and you can find really interesting speakers with sometimes local speakers that tackle really interesting topics. Well, I'm going to go ahead with the introduction. David Chung is deputy editor at AADB and co-hosts an IDB live show on Zoom. His topic today is winning big in 2025, selecting individual stocks during an extremely news-sensitive year. And boy, is it ever. Uh, some of the topics that will be covered is identifying bullish action in daily, weekly, monthly charts in emerging growth stocks that can perform or outperform the averages. Also, Investors Business Daily relevant tools to find excellent market leaders in 2025. And my favorite part of a lot of presentations, name your stock, and David will discuss it using IBD tools. David Chung is deputy program as a manager or deputy marketing editor, as I said, and hosts a broadcast. He is author of the book Investor Business Daily and Making Millionaires, How IDB Rewrote the Rules of Investing and Business News, unquote. David has more than 26 years of writing and editing experience in the US and Japan. I guess worked in Japan for a while, which is a great way to learn the language. He's also a member of the LA Board of Directors as the media liaison. David has 2 X handles. And if you look at the biography, you can get his email address, and he welcomes questions because that's what he does. Anyway, David, you have the forum. I'm looking forward to your presentation.
Really appreciate it. Thank you, Lynn and Deborah and Celia, for the very warm welcome. It's truly an honor and a pleasure to be with all of you today. It's really cool to also see a number of chapters involved with this Saturday event. So really appreciate your time on a weekend to talk about obviously one of my passions in life, and it is the stock market. As Lynn noted, I do host a show on Tuesdays. It's called IBD Live. There you see the information there. And this is the actual place where I host a show. This is not a screen, a background screen, but the real office. I'm just kind of fiddling with my camera, but you're seeing me actually sitting inside our LA headquarters on Wilshire Boulevard from the 29th floor view. And so it's exciting to present the IBD take on the market, on growth stocks, and other related topics. You can see on this first page here that I'm totally open doors in terms of communication. If you have a question or comment or suggestion to help me become a better presenter, or for IBD to expand its content, please email me, david.chung@investors.com. You can also DM me uh, on X. I'm pretty active, especially through those two handles right there, at Saito-Chung and at IBD _ D Chung. Now Lynn said that I in fact did have experience reporting in journalism in two countries, Japan and the U.S. And just fun fact, I actually started out as a stock not as a stocks writer, but actually as a sports writer, and I covered more than 30 different sports, everything from Olympic speed skating to sumo at the Grand Championships in Tokyo, and that was a great introduction to learn how to write, learn how to cover things fast, and convey a story. So that's really worked well for me, I hope, in the stock market. So the hopefully the bulk of my presentation today will be answering a lot of questions. I don't have a very long slide deck. I just wanted to present the current view of what the stock market is doing from the IBD lens, but more really focus on how to pick great stocks both in 2025 and beyond. I used this slide during the February chapter meeting for LA, and I still believe that no matter what headlines you see out there, and no matter what gyrations we have in the market, there's always going to be an ocean of opportunities, and hopefully this talk will help you discover some of them. So where are we now? Well, since March 3rd, which was this past Monday, IBD decided to downgrade the current outlook of the stock market to, as you can see here, market in correction. And before I start, I want to make sure, I wonder if I can scribble on these slides or not. Let me, annotation. Okay, yeah, good. I can do that. Great. All right. So that is a Zoom tool that I use right there. And here you see a daily chart of the S&P 500. What's key to understand is that lately we can see a tremendous amount of distribution. In other words, institutions selling shares, taking profits out of concerns over the future state of earnings in the economy. These red bars highlight a lot of heavy turnover as the major large cap index fell, and you can see over here in mid to late February, we crossed below a very important technical level, the 50-day moving average. And this dotted line shows the average closing price of an index or a stock over the past 50 days. So 50 days, you would consider to be 2.5 months of trading. And so right now, as of this day right here, March 3rd, we told our subscribers, look, it's time to raise even more cash, and we lower the outlook to a recommended exposure level in the stock market for active investors, not necessarily long-term investors, but for active investors, to a 0 to 20% level. That means having a very large amount of cash for those who like to time the market and like to buy and trade growth stocks. So as you can see, we are down now in the S&P. It's interesting. Just less than 2 months ago, at this level here, IBD was suggesting that you could be nearly fully invested in the stock market because we continue to hit higher highs and higher lows in the stock market. But now you can see, well, after hitting this all-time high here, we're starting to really fade here, and we just recently hit a lower low compared to these lows right there. Now, another thing I like to highlight is this advanced decline line, and in general for stock pickers, when this line is declining, that means it's a little more tricky, a little more challenging to be finding stocks that can really first buck the the overall weak trend of the market and can outperform the actual S&P 500. I would say right now the S&P is in a in a pullback phase, not quite a correction, but when you look at the Nasdaq, you can see that it is a deeper slide, because right over here I highlight that after Friday's positive reversal up, we are now 9.9% off the high. However, we're actually at the very low, have now experienced a 12% haircut, if you will, from the peak of 20,204 that happened in this area. So at Nasdaq, as everyone knows, is very highly tech weighted. You can see that here in this little area of the chart. These numbers, the first number is the weighting within the Nasdaq. Nasdaq, like the S&P 500, is market cap weighted, and so if you just take the first 5 or 6 companies, or basically pretty much the Mag 7 ex Tesla, if we add them up, 18, 25, 31, 36, more than 40%, almost 45%, in fact, of the Nasdaq is still driven by a lot of companies in a lot of your neck of the woods up in Silicon Valley. We also have some retail companies, consumer companies, medical companies, and here's another medical company that also are quite large and have some influence on the Nasdaq. But nonetheless, I think it's very important to see how the breadth of the market has really weakened in recent weeks. We have hit the lowest levels in many months, and I think technical analysts are going to probably talk about, well, where if we have a continued slide, where are the next levels of potential support? So perhaps 16,600, perhaps 15,800 would be those levels. If the Nasdaq were to go that far down, then that would mean we are truly in our first bear market since 2022. I'm going to talk very briefly about sentiment indicators. For a long time, when we were in the midst of a correction and wondering when we could see a turn, we looked to some secondary market indicators, such as that put-call volume ratio. This is the simple ratio among all the options exchanges of how many puts are traded versus how many calls. Puts are generally considered bearish, and calls are generally considered bullish. And in the past, we had seen, as in recent history, that when we go above 1.10 or even 1.15, when we have a plethora of puts versus calls, we often see a turn in the market higher. And the reason is, when more people are bearish than bullish, it indicates that more people have already coughed up their stocks, loaded up on cash, and are sitting on the sidelines. And when that cash is sitting on the sidelines, when good news affects the market and helps the market turn, those people on the sidelines are now likely to become willing buyers. So that's why we look at contrarian indicators to help us look for what is ultimately the most important signal that IBD has discovered with the leadership of our late founder William O'Neill, who started IBD in 1984. At this point, I think it's fair to be looking for a follow-through day. A follow-through day doesn't work all the time. It's not fail-safe, not 100% accurate, but in our research, going back to every major stock market bottom, and that includes about 24 major bottoms going back to 1900, every single major new rally started with a follow-through day. And in simple language, what is a follow-through day? Well, you have to have a solid gain. Currently, it's got to be 1% or more. Sometimes we demand it to be more amid more volatile market conditions. That 1% or maybe 1.5%, 2% gain on either the Nasdaq or the S&P 500 most typically happens on the 4th to 7th day of a new rally attempt. And what I mean by new rally attempt, we simply call that the first up day in a move. So right now, as of Friday, after this positive reversal higher, we would look to 4 days into this potential rally for a follow-through day. And as many of you who are IBD subscribers know that sometimes follow-through days happen much later than that 4th to 7th day time frame. But they can work, and it kind of depends on the I would say the magnitude of the correction and whether we are within a secular bull market or not. But in general, generic follow through days have got to happen with a strong gain, 1% or more, and the volume on that day, ideally both in share volume and in dollar volume, must be higher on the exchange than the prior day. Okay, so a little brief water check, water break there, and let's go back to the S&P. Same deal. S&P had a bad week, as we can see. These red bars with the closing hash marks show down days, and the volume is colored in the same color. We have a blue up day. That's day one after a pretty decent pullback. But I'm more focused at this point in what the Nasdaq might be doing going forward. As you can see, as I highlighted about the put-call volume ratio, one key sentiment indicator, which has proven to be still very useful, we are still below that threshold where we would say, oh yes, there's quite a lot of bearish sentiment, and therefore we might want to look for that contrarian turn up. Where is the new leadership right now? Well, part of it is seen in the blue chips. As this tiny chart shows, the Dow Jones is actually up while the Nasdaq is down 6% in less than 3 months. We hate to, you know, what do you call sort of think that, okay, well, if this continues, the Dow will end up with the small gain, and the Nasdaq could be like down very sharply in the double digits. We don't want to estimate or guesstimate that that's going to happen by December. But at least for now, currently, we are seeing institutional investors and investors leaning a little bit more toward perhaps less expensive, more defensive, blue chip large companies. So if we look over to the left side, it's interesting to me that this ranking of 197 industry groups does still continue to show some technology. Here's tech services, education software. This group, for instance, has been boosted in large part by a company called Duolingo, DUOL, a foreign language app that's really, really, really hot right now. Internet content, obviously, because of the strength of Meta platforms and Google or Alphabet, has helped this group remain in the top 40 rankings in terms of 6-month performance. So here you can see 6-month performance, and these are top 40. But you also see that there's a desire to get yield. Airline stocks have cooled off really sharply in the last couple weeks, but remember, this is a 6-month gauge, so they still are a leader. And as we know, there's been a slow but steady trend higher and new highs within the price of gold, and that's helping boost those gold mining stocks. Telecom wireless, I would consider to be sort of more of a safe haven area, almost a utility, if you will. But with the growth of AI and the continued use of computers, look how strong the security software group is here, ranked 15th, and in fact improved from its ranking of 31st 6 weeks ago. On the bottom of the barrel, or in the bottom of the barrel, you can see that, for instance, home builders have really, really struggled. Oil and gas drilling not doing very well, despite the initial hope that the new Trump administration would help boost the energy industry. There are a lot of issues that are preventing new exploration within oil and gas because of, in part, the tariffs that make it more costly, in fact, to drill. Steel prices going up, and you can see also that some of these consumer areas have also been affected and are in in laggard territory within the stock market. So just wanted to show a little color as to what is leading and what is lagging. I should also highlight the investment banks. Uh, they were as a group sort of laid hung to dry for many years. And I remember not long ago on the cover of Economist magazine, they had a picture of Goldman Sachs, uh, their I guess their icon that was melting like like hot butter in the sun, and the title was jokingly referring to Goldman Sachs as Goldman Sags. That turned out to be a great contrarian signal that, hey, maybe there's everyone throwing in the towel with banks, that maybe it's their time to turn higher. And in fact, that's what's actually happened uh, amid a general cooling of interest rates. All right, so let's move on to the next slide. Lynn, before I move on, any immediate questions you think I should address?
There were questions about how to access your Zoom shows, and I believe you have one. The major one is pay, and there might be a free one occasionally.
Oh, okay. Thanks, Deborah. So, as a co-host of IBD Live, yes, that's a premium service that is subscription based only. We we do sometimes take little clips from that show, which is it's over 90 minutes every day that the market is open. It starts at 6:15 a.m. Pacific time. And so it's really trying to give real-time ideas. So that's a subscription-based product. But as I said, if you tool around our YouTube channel, Investors Business Daily YouTube channel, you can find some clips as well as the free video is called Stock Market Today, which runs live right after the market close at 1 p.m. Pacific. So if you just Google search that, you'll be able to find it. Okay, so a few more charts I'm going to go through, and I'm watching this very closely. This is the bulls versus bears indicator, separate from the AAII bulls versus bullish and bearish sentiment survey. But this is run by Investors Intelligence. We get a figure once a week, and as you can see right now, the level of bullishness among professional investors, which are mainly newsletter writers in this case, has really dropped in the past several months. And we are currently at 36.7%. So that's the lowest level since the start of the bull market that happened in November 2022, after it became clear that one, you know, the rate hikes were going to end, and that the Fed was feeling better about the inflation situation. In the meantime, bearishness among newsletter editors and so-called market pundits has been rising. So you can see that the difference between the bulls and the bears is thinning. Still more bulls than bears, but this doesn't add up to 100. And the reason is that there's about a third of the writers who are kind of sitting on the fence thinking, well, we might have a sort of a correction of perhaps 10% or so. And that I would consider them to be kind of in the bearish camp. So, it's right now a situation where the bulls are in the minority. However, we don't use the bulls and bears numbers as an indicator that the market is ready to rally and rally significantly. But what we have found in looking at a couple decades of the stock market, the way the market bottomed out, and where sentiment is as you can see here, when we have the percentage of bears, the green line, exceed the percentage of bulls, uh, we are we feel like the time is ripe, that the market has bottomed. And from there, we look for a key follow-through day. And that's, in fact, what happened, if I'm not mistaken, I think it was November 1st of 2022. And I have my database here. I can double check that. But that was a very key event that happened 4 or 5 days into a new rally attempt. And we know the rest is history with in 2023, the S&P up 24%, and then last year up 23%. So I would keep an eye on this. This is a chart that you can see within our psychological indicators page on investors.com. On investors.com, just simply hover over the main navigation bar, go to market trend, and then there will be a drop-down menu that talks about psychological indicators. So psychological market indicators, and look for the bulls and bears. All right, let's go on to the next slide. So I wrote about McDonald's for the first time in a very long time. And this is the daily chart on our premium market tool called Market Surge. Investors.com that has charts too, and a lot of financial websites have great charts, but my favorite to-go chart service is definitely Market Surge, because we combine the actual chart action with the fundamentals of the company, and also we have information that you can slide through a panel to the right about the quantity and quality of the funds that are buying XYZ stock. So you can see that technically speaking on this daily chart, we had McDonald's pull back, correct in price, bottom out near the 200-day moving average, go up near its left side high of this, what we call a cup with handle, the silhouette of a teacup with a handle viewed from the side, pull back very, very mildly. Volume was quiet around here. Shuffle around here amid market volatility, and then finally break out yesterday in really, really strong volume here. You can see that the volume was 137% above average. Volume was the highest in about 4 weeks. And you can see that these blue volume bars hint that institutions have been getting an appetite, if you will, for McDonald's stock. It's clearly not because the growth is going to be exceptional. McDonald's today is nothing like it was in the 60s and 70s when it was a monster growth stock. And you can see that in the latest quarter, in fact, this company had no sales growth, virtually no sales growth. In fact, it dipped a little bit versus a year ago. And in the fourth quarter, earnings actually fell 4%. When we're looking for great companies that are going to lead the stock market higher, like the NVIDIAs and the Broadcoms of today, or the Walmarts and the Home Depots of the 60s, 70s, and 80s, or the Microsofts of and Cisco's of the 80s and 90s. We want to look for companies that are growing their earnings and sales year over year, 25, 50, 100% for quarter after quarter after quarter. And that usually happens before the stock makes a powerful move and potentially goes to new highs. So anyone who had bought here at around 311, which would be our pivot point, is now up 10 points in just one day. That's a powerful move and bespeaks the power and the useful utility of a stock chart, because no matter what you read or hear or think, or what your neighbor down the street or your friend at the at the tennis club thinks about a stock, what's really most important is what all the millions of investors who put their hard money into stocks, what they think, and that's what a chart gives us. That's the special information. And this pattern here, if you're new to IBD, is a pattern that we've seen time and time and time again over the past century and a half among the greatest stocks that have been researched by not only Investors Business Daily, but by its former parent company, William O'Neill and Company. IBD was acquired by News Corporation, which owns Barron's, Market Watch, Wall Street Journal, in 2021. All right, so anyway, every dog of the day definitely has its day in the sun. You can see right here that the retail restaurants industry group is a top 40 group among 197 tracked by IBD, number 25th. So it means it's a 25th best performing industry group on a price weighted basis over the past 6 months. Breakouts don't always guarantee success. We do have very, very important sell rules. For instance, if a breakout fails, you must cut your losses short because you can always recover from a small loss, ideally no more than 7 to 8%. And it's much easier to get back even in your account when you pick the next better stock when you're only down 7% in the prior stock as opposed to being down 17, 27, or 47%. Always, as many of you well know, please keep in mind that if you're down 7%, you just need a roughly 8% gain in the next stock to break even and be positive. You could have 3 7% losers in a row, but if your next stock acts like a true leader and you sell it at 25% or higher, you'll be actually making money. And so that's sort of like the major league slugger on the Giants, on San Francisco Giants that gets paid millions of dollars to hit a home run once out of every 10 bats, or gets a hit 1 out of 3 or 4 at bats. So it's a very similar situation with stock trading and stock investing. You really want to minimize the damage with your losing trades or losing investments and maximize the full potential of your winning ones. So with McDonald's as an example here, even if you don't mind the relatively mild nature of the earnings and fundamentals going forward, no matter what, if this stock works out, I would expect McDonald's to go from 321 to ideally over time 400, because 400 from 311, that's a 99, 80 point 89 89 point move. That would get you a gain close to 30%, which would be terrific. If the stock were to fall 5-7%, I would be out of the stock because it would show that this breakout turned out to be a real fake out. And for that reason, on this chart, we show that this is the area where you should be cutting your losses if you bought on this breakout point here. Some of you like to buy low and then sell high, and that's fine. There are times where you can sense that, oh, okay, there's some oversold situations, and you can see here and here that the stock was down. This is a red bar, but it also finished at or near its session high. That's usually a sign that the sellers have become exhausted in the short term, and that maybe the buyers will come in and push the stock up, and that's exactly what happened. But in general, we don't really advise buying low. We really want to find the stocks that fit the pattern of former past big winners, because there's no doubt that human nature has not changed and repeats itself. You could say that the stock market is all about emotion, is all about fear, which is selling, and greed, which is buying, and following the herd too. That's what sustains a breakout to new highs and big moves. Notice here too, like if you were to use the 200-day moving average as your buy signal, well, there's also times when the bounce off the 200-day doesn't work, and you could be faced with losses, as was seen here. Even though this is a chart of the S&P 500, and this is up, McDonald's was actually going down. So once again, this is the S&P 500 chart. It's been rising, and yet McDonald's was lagging. So it was a laggard stock. Relative strength was weak, but things have certainly changed since the end of last year, right there. Also, I wanted to show McDonald's because I think it's really indicating where the money is flowing. Back in 2022, 2023, 2024, we saw AI stocks, or at least some AI stocks, really move, and related software stocks move, and obviously those AI data center infrastructure plays, whether it's a cooling infrastructure from the likes of Vertiv, VRT, or uh, uh, energy providers that focus on supplying energy. We know CEG, Constellation Energy, was a big mover recently because of a big contract that it got for power with Microsoft. However, in the current environment, we are seeing those kind of stocks really correct in price. They might have gotten just way overbought, and now are just in what we call a consolidation phase. All right, so just a few more slides, and then we'll go into Q&A. As a journalist, I pay most attention in terms of external factors on the market, not only to whatever news that we see on CNBC and Reuters and Wall Street Journal and Dow Jones and Bloomberg, but I really closely look at the direction of interest rates and earnings. So first, let's look at earnings. This is the latest press release from FactSet, and it says that right now, what's positive is that Q1 earnings for S&P 500 companies is expected to be 7.3%, and this is year over year, not quarter versus quarter. And John Butters, who we've quoted a lot at IBD, notes that if this really happens, it'll be the 7th straight quarter of year-over-year earnings growth. So very, very positive factor for stocks over the past 2 years. Now, I would skip down to earnings guidance here. It's still early, but you can see that for the first quarter of 2025, 64 companies have issued negative guidance and 39 have issued positive guidance. This often happens because companies want to lowball in general their earnings estimates and manage Wall Street expectations. That gives them a chance to then deliver a nice surprise and ideally boost their stock, because a lot of the management companies, as you know, are paid big bucks through their options and their stock holdings. Valuation right now is definitely above average. You'll hear that. That's nothing new. Forward 12-month PE ratio, in other words, the current price of the S&P 500 divided by the future 12-month earnings expected, is on the high side, 20.7 times future earnings, above the 5-year average of 19.8, but not very much, but significantly above the 10-year average, which goes back obviously to 2015. So I would say that it's interesting that, if you go back 10 years, we've only had three bear markets, and 2 are very, very brief. One was the Q4 of 2018, when Fed Chair Powell decided to do a 180-degree pivot from let's raise interest rates really quickly because I'm worried about inflation, and then there was a tariff. There was the tariff concerns back then, to saying, oh, I don't want to kill the economy. Let's pause in monetary tightening, and that led to a nice gain that happened in 2019. Then we had the COVID sharp elevator-like fall that ultimately turned out to be a strong market for stocks as the Fed did everything it could to make sure we wouldn't go into a recession. And more recently, the more traditional bear market that we had in 2022, with interest rates going from 0.25% to a peak of 5.25, 5.5% on the Fed funds rate. So that was a very, very dramatic shift. Since then, we've only taken a little bit off the top, 4.25 to 4.5%. So the reason I talk about that is because when I look at these numbers, I feel like it's amazing that valuations for the stock market have been relatively high over the past 10 years when you compare it to other decades, well, when economic conditions were not as good and the financial system was much shakier. Just think, the GFC, the great financial crisis of 2008, 2009, the valuations then were obliterated. So in other words, I wouldn't be too afraid of high valuations in the stock market so long as our economy can still remain robust and companies can continue to innovate, produce new products and services, buy back stock, uh, be able to borrow at reasonable interest rates and grow their earnings. These are the underpinnings of a healthy stock market that is able to rise and climb a wall of worry. And that wall of worry is built of many different bricks, right? One of those key bricks is almost always going to be, in my humble opinion, valuation. So at the beginning of the year, I've gone on record by saying I think this could be still a positive year, even though we've had 2 straight years of double-digit gains by the major indexes and a lot of incredible stocks that have made even bigger moves on a yearly basis. And part of that is because interest rates are in a more normal trading pattern, if you will, and are more stable, less fluctuating. This is the 10-year Treasury bond yield supplied by SIBO, and this number you want to just divide by 10 to get the interest rate. So 43.17 really means we are currently at 4.31% yield on 10-year Treasuries. A very good benchmark for what mortgage rates might be. I've heard that some people say that if we get mortgages below 6% down to 5.5%, it could lead to a big home buying boom once again, because it makes new homes more affordable for the Gen Y and the Gen Z generations of our country. But in the meantime, what I think what's interesting is that part of the stock market volatility has, in fact, a lot to do with the very, very large relative volatility of the cost of money. And you can see that here, where we went down to as low as 0.39% on the Treasury, up to 4.33%, and hence the stock market here, as represented by S&P 500, really recognized that. But at this monthly chart shows that we are more in that sort of area where we've had this kind of range, which is still a pretty big range. And believe me, on a daily and weekly basis, we can see equities make corrections and big moves amid a tighter range of interest rates. But in any case, I feel like this is very interesting, because if the interest rates in America were to spike in the same manner that we had a spike here, that could spell a lot of trouble for our economy and for our stock market. So I think it's because of our very large debt burden that the current administration is trying to tackle right now. And you'll probably see once in a while, in Barron's, Wall Street Journal, not much in Investors Business Daily, but other places, about how there are worries that fewer foreigners are owning U.S. Treasury bonds. I've kept an article from 2023 that said the percentage of foreign holdings of U.S. Treasuries dipped to below 40%, and could it even fall even more? Could we be more in a situation of like Japan or China, where a lot, if not most or all of their debt is held domestically? No one knows. I don't know. But I think if the market knows, we're going to see that in the interest rates. So going forward, I would be very alert to watching any big moves in the interest rates, particularly the 10-year past 4.99%. I've always liked to talk about this level as a very important multi-year peak. And the fact that we haven't fallen very much really reflects the fact that the market now doesn't really expect any more than 2, possibly 3 cuts in the Fed funds rate of a quarter point or more. So if we do in fact trim short-term interest rates by 75 basis points, that would take the Fed funds rates for banks, down to below 4%, which is good for banks. We'll see what it is also good for banks because let's say interest rates on the lower end, at the longer end of the spectrum holds above this area, then banks can borrow from the Fed at a lower rate than they can then dish out in the form of mortgages and car loans and home equity loans or whatnot and make a profit. And the banking sector is still a very, very important area of the stock market. So for that reason, I would keep watching the 10-year and also the price action of key banks, whether it's JP Morgan, super regionals like Comerica, and even your own local bank, and see how the stock is acting. Let me check one more thing. Okay, yeah, I just got 3 more slides, and please feel free to take a screenshot of this or take a shot with your phone. But I just wanted to briefly show which sectors within the stock market are leading in the midterm to long term. That's like 3, 6, 9 months. As you can see, internet is still doing well. I'm a little surprised that alcohol and tobacco are ranked number 2 within our stock tables. This is as of Friday's action. As we know, alcohol stocks have not done very well, but some of them have been rebounding now, despite the fact that Canada is taking steps to, like, for instance, ban imports of U.S. bourbon and whatnot. I think maybe this sector is ranking high because just like we've seen this flow of money into companies like McDonald's, we're seeing the same in these companies such as Philip Morris and Altria, which don't have very fast-growing businesses, but have high cash flow businesses, and therefore are able to give healthy dividends to large, patient, long-term shareholders. Mining, obviously related to gold, metals, the same. We have a demographic in America that has a lot of money in their retirement years and are willing to travel, and therefore for that reason I can understand why leisure and aerospace are doing quite well. Telecom, more defensive. Insurance, benefiting from more stable interest rates, if I may, and also clearly the demand for insurance and the price and the price hikes that have come up as a result of a lot of climate-related natural disasters. Utilities, here again, dividend play. Banks, kind of a bet on interest rates, and food and beverage defensive. So, these are kind of the areas where I would be watching for potential leadership within the market. Now, the new highs list is clearly showing more stocks hitting new lows versus new highs. And when we look at when we go to market surge and other charts, I can show you in more graphic detail how more stocks are hitting new lows than new highs in recent weeks. But you can see there are a minority of stocks that are still, believe it or not, making new highs, even with the NASDAQ down 10% and the Russell 2000 correcting nearly 18%, I believe. So let's look at those. This is our new high list, updated every day. It's on investors.com. You go to IBD data tables and then click on new highs. But let me show you what's comprised of this list. And right now, if you click on new highs here or new lows, you can see the actual sectors that are sort of at the top of that list. So right now at the top of the list, I highlight McDonald's, and the retail sector among 33 sectors covered by IBD is number one on Friday. We have BJ's, we have Kroger, we have AutoZone, we have Yum Brands. So these are all real blue chip, high cash flow companies. Yeah, not the best earnings per share rating. This rating goes from 1 to 99. When you want to find the next NVIDIA, usually you see their EPS rating grow over time to the high 90s. It might not start at 99 when they make their big move, but it eventually gets there. Mining is also a strong sector within a weaker market. We also have real estate, banks, a little bit of software, and medical right there. The reason why some of these numbers are highlighted in blue is because that indicates that their earnings are growing very, very rapidly, both in the short term, last couple quarters, as well as in the past 3 to 5 years. Oh, okay. Yeah, I think I decided not to show the new lows list, and that's my simple slide deck, and I because the slide that covered my entire screen, I couldn't see any of the questions or comments or criticisms. But I hope there are questions that then I can share charts and go from there and really keep it live.
There's 3 general questions that came in. Should we handle them and then take a 10-minute break and come back for the more specific questions?
That's good. If the group wants to do that, absolutely.
Okay. First one is the puts versus call trading volume indicator something available in most trading platforms like Think or Swim?
Oh, Thinkorswim? Yes. Yes. I believe, don't quote me here, but I believe on Thinkorswim, if you type in .pc, you should get the put call volume ratio. And if you don't just send an email to their customer service department, but any index is usually going to start with a dot and then P for put, C for call. We use I'll share my screen real quickly and show you what we do. Let's see here. I'm going to show the live chart of market surge. So, Deborah, can you see my NASDAQ chart?
I see a chart. Yes, I do.
It is. Okay, great. So, for instance, we use PCVR. That's put call ratio. And you can see it's only one data point. So that's why it's just a bunch of dots. That's why I kind of like to look at the weekly. So you can see weekly numbers for the put call. And you can see that back in March of 2000, as COVID became a global pandemic, you can see that the put call volume ratio, the number of puts versus call, was so high that there were 144 puts traded for every 100 calls. 144 versus 100 calls. That's an amazing spike. We saw a similar spike here in the fourth quarter of 2022, where 161 puts traded for every 100 calls. So that really illustrates that very, very high level of bearishness that often comes near the end of a bear market.
Okay. What is your take on Trump's tariff rhetoric impact on corporate earnings?
Great question. I don't think anyone really knows, other than the fact that it is making decisions, business decisions for corporate executives just a lot more challenging. We don't know how long and how strong these tariffs are going to happen between U.S. and its very important trading partners. And therefore, I try not to make any strong opinion about it and just really just gauge the entire market's view by watching that daily action, both price and volume of the Nasdaq, the S&P 500, various sectors, and let the decision making go to the market.
Tesla stock influence on America car stocks.
That's a great question. Well, it is an incredible disruptor. We all know that. We know that also that the growth has slowed a lot. You can see that here. This is the weekly chart of Tesla. And, over the past 8 quarters, they've seen a lot of declines in earnings, and they've seen a severe slowdown in the growth on the top line, the sales. These numbers are in billions. It is remarkable what Tesla has achieved without question, and that the compounded annual growth rate of the stock is superior to most stocks in the market when you go out 10, 20, 10 or 12 years. And I think I have my business calculator under my desk, so I don't want to go and get it right now, but I can calculate it later. But if you look at the move of Tesla ever since they hit a home run with the Model S, right? Very much remember this breakout in April 2013 when it was trading at $40 a share before the splits. So you can see right now, on a split adjusted basis, Tesla broke out of this base and started a humongous run at a split adjusted price of under $3. And from that point, over the next 12 years, we've seen more than 100-fold move. So on the day-to-day basis, volatile, weak, absolutely. Concerns about the fundamentals, for sure. Competition on the EV space, growing. Concerns about the short-term growth of EVs amid various economic, political factors, a big concern. But when you look at the overall chart performance of Tesla, it is astounding. I'm going to guess, without using my calculator, that CAGR, that compounded annual growth rate, this is something that I, as a longer-term investor, love to always analyze and look at and judge a stock by. That CAGR has to be somewhere in the 30 to 45% range. Maybe after a break, I'll calculate it and see. But my goal for myself as an investor and as a journalist and as someone who's interested in stocks like everyone on this Zoom call is to find those truly extraordinary, exceptional stocks. We know that Honda, Toyota have had a lot of success in hybrids, but they're even also recognizing the importance of going into the EV space. Here's Toyota. Has done a little bit better in more recent years than GM. Here is XPeng, one of the hottest Chinese EV makers. Not a great looking monthly chart, but if you go to the daily chart, you can see that we had a breakout based on IBD principles of chart reading from a double bottom base. A double bottom has a initial sell-off, an interim rally, and then a deeper sell-off that undercuts the first sell-off low. Well, XPeng had a beautiful breakout at around $14.66, and we're up $9, which is impressive. That's more than 60% in the space of 1, 2, 3, 4, 5, 6, 7, 8, almost 9 weeks. What a move. We don't suggest, based on our rules, to buy now, because you're buying well extended from our buy point based on research and on pattern recognition based on what other great stocks have done. But you can see that clearly Tesla is under pressure from its China cohorts or Chinese competitors. Another good example would be BYDDF. BYDDF, Buffett, being an early investor, has had a nice run recently after it broke out of a base at 42. We could also draw maybe a trend line across the highs of the base as it was consolidating the prior big move of gains. And you could argue, well, yeah, once it bounced off the 50-day moving average and rose above this trend line, it was also a buy. So from around $36 or $37. We've had, a 25 to 30% move, a sharp pullback, but it's still rising in a general term. So long-winded answer. I'm glad someone asked about it. Tesla is definitely under pressure, and I think the next big move by Tesla could be predicated on the potential success of expanding its offerings in EVs, building out what seems to be right now a leading position in battery storage. Battery storage is their fastest segment in terms of uh, earnings growth, which is good, as well as whether they're going to actually deliver big revenue through the Cybercab.
It's 10:04. Should we take our 10-minute break now and reconvene at 10:14?
Sounds good.
Okay, great. And first off, I wanted to let me share the Tesla chart one more time. So, Lynn, can you see my Tesla chart?
Yes.
That's great. So, I promised that I would whip out my handy dandy business calculator here. This is my second BA2 from Texas Instruments because the first one I used so much, it just broke down. So this is a relatively new one. But I love this calculator because I love to analyze stocks from a compounded annual growth rate perspective, CAGR. And looking again, once again, at the Tesla breakout in April 2013, no doubt that the IBD style buy point was at a split adjusted $2.67. Since then, rose to as high as 488 in December. So not only is that a ginormous move, as we know, the compounded annual growth rate was 51%. 51%. You compare that with the general wisdom that the stock market will deliver 8 to 10% returns, and that just goes to show how incredible Tesla stock has been. So, kudos, big congratulations to those of you who have made, a fortune in this company. Keep in mind that's been a big move already. So, it's perhaps going to be a lot tougher for Tesla to achieve the same over the next 12, 13 years. But who knows? Elon is a very gifted entrepreneur. Let's see. There's also one other thing I wanted to say. Yes, Lynn and Deborah, if you don't mind, before I start going through all the other charts, I thought the question about tariff policy and what businesses are going to do was an excellent question, and I just thought about it as I got another cup of coffee about how some companies like Apple and Tim Cook have really taken the initiative to engage more in reshoring, right? We all know the news of their planned investment of 500 up to 500 billion, if I'm not mistaken, in manufacturing facilities based in Houston, and who knows how long that will take, but that is a bold move, big investment for a company. 500 billion is amazing, but keep in mind that the company also, and that's probably 500 billion over time. Well, the company had 133 billion in sales, and so this is a major investment. And please excuse me if I'm wrong about that figure, but I think a lot of people were blown away by that news. And so we shall see whether there's going to be more of that trend to bring back manufacturing to our country. That's clearly what's happening, for instance, with a global company like Taiwan Semiconductor. We know that Toyota has invested heavily in the country as well. I think we're due for a lot more changes. So I'm going to just go through these charts like I would normally on IBD Live, As I mentioned to you, I'm host of the show on Tuesdays. And if you haven't seen the show, and I hope you're interested, please check it out. And in the meantime, let's take a look at Zim. This is the first stock I saw in the Q&A, and I really appreciate the question about this one. It's interesting that one, you're going to have earnings coming up next week, so that could drive a big move up or down the stock. It's interesting to me that right now the relative strength rating of 96 is very favorable. And this means that Zim Integrated is outperforming 96% of our database of 10,000 stocks over the past 12 months. And you can see that because the stock bottomed out more than a year ago here at around $6 a share. Now we're at 20. So in terms of 12-month move, despite the fact that we also had major cash distributions to holders, that's what the dollar DIS means. It doesn't mean Disney, but a distribution of cash. Stock has done relatively well. There could be a potential breakout here because I see a double bottom base forming, and in a double bottom, you have the first low, a rally that fails to go to new highs, and a second low. And if the report is favorable, I would expect Zim to rally above this 23 resistance level. So a lot to be watching here. I also mentioned that IBD's analysis, which I 100% believe in, also looks at the quality and quantity of fund ownership. This company is based in Israel, so I'm not sure whether this is the largest equity market for Zim Integrated. They might be traded in Europe as well. And therefore, maybe some funds who are owners might have shares in another stock market other than the US, but you can see that the number of mutual funds has been rising, and that's a positive over the past 4 quarters here. According to our database here at Market Surge, 10%, or excuse me, 19%, let's see, let me clear those drawings. 19% of the stock is owned by mutual funds and hedge funds. So that's a pretty big stake. All right, let's move on. Also, just it's going to be interesting too how the street reacts to their outlook, because you can see that this is a cyclical company. Earnings are very volatile. You can see big net losses, huge gains after COVID, big net loss, and now expected to be a big gain this year. But then why is earnings expected to plunge 85%? Perhaps you might want to look a little bit more under the hood in terms of what's going on there. Next stock I saw was Intel, INTC, and Intel got hammered last week, down 13%. Really, it's unfortunate to say this, but Intel is just not the Intel it was in the 90s. We all know that Intel was numero uno in the chip market. They were part of the Wintel combination, right? Microsoft Windows and Intel inside. And that stock was a rock star, especially here in the late 90s. This is a monthly chart, and you can see that the stock just had a tremendous move, especially on this breakout here. As the internet started to rise, so did Intel. Intel is just not the same stock anymore. Excuse me. So not only we can see that in the chart, but we can see that in the relative strength rating, 20. This means that 80% of the stocks in our database is outperforming Intel over the past 12 months. If we go to the technical indicators here, we can see also that the 3-month relative strength rating is rather weak at 48, and the 6-month, in other words, the price action over the past 6 months is also pretty deficient in terms of looking for a stock market leader. We generally want to look for those stocks that have, in general, a relative strength rating of 80 or higher. And if their 3-month and 6-month ratings are also 80 or higher, then you know that the stock is not only outperforming most stocks over the past year, but also the past 3 and 6 months, which correlate obviously to first quarter past since earnings and second quarter since earnings. So major reason is the dearth of sales growth. You know, sales are the mother of earnings. Earnings are the mother of great stock prices, stock growth. And so we can see that despite the valiant efforts of Pat Gelsinger, who's now no longer going to be CEO, the company has really failed to, find a new product to catch fire or present a product that can match up to Taiwan Semi or NVIDIA. So that's the problem I see with Intel stock. And for those who might have, might be nursing a big loss in the stock, just keep in mind that there's nothing wrong with selling a loser and getting some cash out of it, because you can put that cash into a better stock. And if you sit with a long-term laggard stock, the problem is compounded by the fact that you have that opportunity loss. If you don't invest in a new market leader, then you're losing out on that potential upside as well. Let's see. The next stock was LX. And this is a China stock that I remember trading once before, and I think I took a beating in the stock. I had to sell it for a loss, and I remember this being very exciting in the fintech era. Stock has been great, Lexin Fintech lately, moving in line with Futu and Qihu, I believe. Those are two other China-based fintech companies. Nice to see the sales growth is very substantial in terms of quarterly sales and also growing. Notice here that the earnings per share have fallen. That's why these numbers are in red. And I think part of it is because in the year ago quarters, you can see that the growth was very strong. So they had some very tough year-over-year comps. Nonetheless, we have a nice breakout here at $4.70, and it's more than doubled, which is very impressive. These pullbacks to the 10-week moving average after a solid breakout from a base here give you a second chance to add shares or even enter the stock. So far so good for Lexin Fintech. I'd be curious to see what it does, in the next 3-6 months, because does it come up to these old highs? And from there, does it form a new base and then possibly break out to even higher highs? That would be very impressive. What's interesting here, you got a 99 relative strength rating. The group is quite strong, and the composite rating is also quite good. Composite rating combines our earnings, sales, ratings, relative strength, and fund ownership all into one score. We don't use the composite rating for market timing, when to buy, when to sell. It's best used as a screening tool. So just keep that in mind. Finally, this is a small cap, 1.5 billion. Now, NVIDIA is a stock I do own, full disclosure. This has been an amazing winner. If we go back to the monthly chart here, you can see that the stock has also made a 100-fold move after it broke out of a cup with handle here, which you can't see on the monthly chart, but this is a cup with handle that was formed on a daily. And under $1 a share up to 112, even after the current correction. So what I see right now is a stock that is clearly being controlled more by the sellers than the buyers. As the stock digests what's been a magnificent gain, even from the bottom of the 2022 bear market, you can see the stock had a 10-fold move. So it's definitely earned earned its right to take a rest right now. I am concerned about how far it falls below this 40-week moving average. And that's kind of like what the 200-day moving average looks like on the daily chart. Right now, we are 12% below the 40-week moving average, which is makes you wonder, is like, are we entering a phase like over here where the stock never got back above the 40-week move average and then made a very, very deep correction? Or do we bounce back from this low and then try to form a new base? The only way we'll know is just by watching it on a day-to-day, week-week basis. What's also interesting here is that, you know, the recent breakout really did not produce much of a gain compared to breakouts like here. This is a weekly chart, everybody, and a breakout from this base on base, which is a double bottom and a flat base on top of it. If these terms are confusing you, just you have the weekend to possibly do a little Google search of my stories on the flat base, on the double bottom. If you type in site, SITE:investors.com, and then put in my name and then flat base or coupled handle, you'll have plenty of articles in which to really learn about these very, very important patterns for finding growth stocks. 44 relative strength is definitely a concern. And you can see, since the stock has not hit new highs for a while, that relative strength rating is also weak on those shorter time periods. Okay, so moving on, we'll go to SMCI. Big run, great stock, amazing stock. And then they ran into reporting difficulties and doubts about their fundamentals. And hence we had a big correction. And it's amazing that, you know, this is probably a great stock for those who are short-term swing traders, because it can make a move as much as 32% in a week, and then but also can fall as much as 26% in a week, as you can see here on this weekly chart. Let me zoom in a little bit more so it's a little bit easier for everyone to see. But this is the a month ago, up 32%, up 17%, but now back below the 40-week line, getting supported that rising 10-week moving average, which is that red line right here. These are simple moving averages. And so it'll be interesting to see whether SMCI continues to work on its bottoming out process. You know, from this peak of 122 down to 17, I mean, that is a major, major correction, almost 19%. So let's figure this out real quick. Yeah, that was an 86% decline. It goes to show why it's important to be buying at, you know, a key breakout level than just buying on emotion. Like when people up here, buying up here, they had really no business buying up here, because that was well extended from this breakout of a nice base here at around 36. So I can't overemphasize the importance of having good buy rules and sell rules based on your investing or trading strategy. That said, good relative strength rating on the 3 to 6 month, very, very bad relative strength rating on 12 month, and we can see it because over the past year, stock is sharply lower. Also, I want to highlight the fact that what is positive is that the fundamentals do look like they're headed for more growth. And you can see that after some really big year-over-year comps, the earnings growth has taken a hit, but now expected to re-accelerate in time, as you can see here. Sales also expected to grow at a very, very healthy clip, although not at the same level as during the boom driven by ChatGPT and the development by NVIDIA of its AI and accelerated computing chip systems, which is really, truly amazing there. Okay, next stock is SoFi. And SoFi has delivered a sell signal. The reason I say that is, well, one, when you break out of a base like this, our normal selling strategy is to sell at least some shares on the way up. And when you have a 20-25% gain, the IBD rule is to sell at least a portion of those shares so you lock in some gains just in case just around the corner you have a correction. And that's exactly what's happening at SoFi right now. You can see that the stock obviously went more than 20% higher, had a test of the 10-week line here, and arguably created a follow-on buy point when it crossed back above the 10-week line at around $15.47. Went to new 52-week highs, which is great. But then when it started to come back below the 10-week moving average and then failed to rebound back above it, that's when we could justifiably say that the stock was now showing a change in character. For instance, this 9.5% drop turned a very healthy gain into a negative reversal, and it closed 6% below the 10-week moving average. So based on technical action alone, it was just not acting. It wasn't acting right. Of course, if you go back in time, you might think, okay, at this point of the chart, maybe it's in kind of like a trading range. But the one thing I would like to say is that SoFi is a new, exciting, innovative company. The chart, however, is a very wild, volatile stock. So you have to be aware of that risk with something like SoFi. And you could also say that the chart action was different compared to this really nice streak of gains. 1, 2, 3, 4, 5, 6, 7, 8, 9, up 9 weeks in a row that helped power the breakout and delivered a very, very fast 20% gain. Bill O'Neill had a rule for the very biggest potential market winners once they rose 20% in 2 weeks or less, and more recently to over a period of 3 weeks or less from a breakout point. Bill O'Neill created a special rule to hold such stocks 8 weeks or longer, just so that maybe he could discover whether the stock he was owning was going to blossom into a major winner. Selling them too early, can be a big mistake too if the stock doubles or triples after you sell it, right? And we all don't want to leave that kind of gain on the table. However, I don't think the 8-week hold rule from a breakout point always applies to every stock. And part of it is because SoFi is not exactly the kind of game-changing stock that we would argue was Home Depot, Microsoft, Cisco, Apple, and more recently, NVIDIA. So from here, we can see that the action grew more negative. And you see with a further drop below the 10-week line, I would say those who followed IBD buy rules and bought here just want to make sure that you don't lose all that gain. It's very possible that the stock could test that 40-week moving average now. Fortunately, that 40-week line is above the 10.49 original breakout point. But that said, if you if you sell a stock as it's coming down and you're a little bit, you're disappointed by coming away with a much smaller profit than what you had a month ago, just keep in mind that, the market doesn't care what you or I do when you and I sell. And if the stock becomes a great winner again, you can always just buy it back. And as I like to tell people, the market will never know that you bought it back. So always keep on the lookout for that next opportunity, even when the stock is acting weak in the short term there. Next stock here is SoFi FCX. Looks like this copper mining company is trying to bottom out. What I see here is that you had a nice cup with handle breakout from this commodity play. That breakout was at 43.42. So using standard IBD sell rules, we would say take some profits once it reached about 51, 52, because that would be a 20% gain from 43.42. Now, if you want to go for a 30% gain, that's fine. If you want to set a higher target from 43.42, that means you would start selling when it was at 56. So did it get to 56? It didn't quite. Got to 55.24, which is almost a 30% gain from this cup with handle breakout at 43.42. Notice that the importance of this sell rule is because stocks often and do round trip those nice gains. So if you don't have a sell rule to help capture gains on the upside, it can be very frustrating to see all that gain disappear like that. Currently, now we have a stock that is now trying to bottom out here. I see a positive reversal there, positive reversal there. Look at that heavy volume. Earnings are going to be coming next month. We shall see whether this stock can revive itself. But right now, it just feels like that even though President Trump might be trying to protect U.S. industries against unfair foreign competition, there are a lot of unintended consequences that investors and government leaders and corporations have to consider. So from that point of view, to me, it feels like Freeport is not really high up on my watch list because it doesn't have the relative strength, both on a long and short-term basis. And the stock is, the stock is very volatile because of its link to commodities. Nonetheless, I'm sure we'll keep an eye on these copper stocks because, at least for now, Wall Street thinks that earnings could grow and end a 3-year slump, as we can see here on the annual numbers over here. Okay, next one is Amazon. I do manage an account that has a long-term hold in Amazon. And right now I see that you had the similar concept here, whereas you had a breakout for those who bought recently. You could say that, well, this is a consolidation, like a base. I see more of a cup with handle here, left side, right side, and handle that generated a 195.37 buy point, had a nice gain from there. Now it's fully round tripped. So depending on your time horizon and your strategy, here again, if you're a recent buyer, it really made sense to lock in those gains, especially as it caved below that 10-week moving average here and then kept going down in accelerating volume. Right now, Amazon is, at least the stock is at a critical juncture, because as you can see here, it fell below that 40-week moving average. It fell below the average close over the past 40 weeks, or 10 months, and then righted itself. It rebounded nicely. This was a very impressive reversal here. You had Amazon down 8%, heavy volume. You can see volume was 60% above average over the past 10 weeks, and then it kept really collapsing as the market did too. You can see here the S&P 500 was falling really sharply. And we had a big sell-off on August 2nd and August 5th. Then the market turned because people realized maybe people were getting a little too nervous about the Fed's fight against inflation and the possibility that maybe we wouldn't be cutting interest rates as aggressively as originally thought. That was leading that bull market ahead. But what's interesting here is that even though it was down to as low as 151, it climbed its way back to just a 96-cent loss, down 0.5%. And if you guys look, when I click on this weekly bar, you can see that pop-up window in gray, and there's a figure there, 1, 2, 3, 4, 5, 6, the sixth row, the sixth line from the top. It says CLS range, 91%. That means for that week, between the low and the high of that week's trading, Amazon traded in the upper 91% of that range. And that's very positive because that means even though it was a down week and it's painted in red, and even though volume was heavy, the stock fought its way back off the lows as buyers stepped in, bargain hunters stepped in, big institutions came and they backed up the truck and they loaded up on Amazon shares. And that resulted in what you could argue to say was a very constructive, positive week that also highlighted a turn in the sentiment for the stock. After that, then you see more up weeks in price versus down weeks, tight action, as you can see here with the light blue shading. This light blue shading highlights tight closes on a week-to-week basis. That's positive. That means when you see those tight closes on a daily or more importantly on a weekly basis, it highlights that holders are refusing to sell their shares and dump them and cause some volatility. Then you had this big move up, a breakout, past a handle at 195.37, a big strong move all the way up to 242. So basically, 50 point move, a 50-point move from 195 was a gain of 25%. A good time to take some profits. So we'll see. With Amazon, I think this is an important stock. That's why I'm spending a little more time on this one as opposed to the others. That is this the bottom? Nobody knows. I don't know. Doesn't care what anyone doesn't really matter who and what anyone say about it. But it would be bullish if the stock can hold this low and then proceed to form a new base. This is a steep drop, but this is not abnormal for a stock that's going to produce a brand new base. Not abnormal so far. We are 17.8% off the high. That's also not abnormal. A good cup of handle will often fall between a 20% and 33 or 35% decline from the high to low percentage-wise. So, with Amazon, if we peaked at 242.50, I'm going to take 242.50 and I'll multiply that by 0.7. That means a 30% decline from 242.52 would get it down to 170 around here. So it's very possible that the stock could come down to this level on the chart and still form a normal future cup base that could then generate a new leadership type of breakout. Okay, on to WBA. Not much to talk about here because the company has now received a cash offer. That's what the CO means. For around, I think, $11.75 from a private equity company. So if that happens, stock is going to be removed by the stock market. DQ. This is in the very, very challenged solar energy space. So I'm just going to warn you that solar stocks are very, very difficult to trade. They're difficult to hold too. This was a stock that had a great run. For someone who was trading this over a short period, this was an amazing breakout. It almost did a 10-fold gain. But you can see since then, stock has been a laggard, 39 relative strength rating on a 3-month basis. And the stock is well off that all-time peak of 130.33. This gives me an opportunity to mention that one great piece of IBD research is that based on studies of decades of great winners, once a big market winner has topped, please write this down. Keep in mind that after a true stock market leader has topped, the average decline is 72%. In other words, a stock can go from 100 at the peak down to 28. You don't want to be caught in that kind of drop. That's why it's so important to use moving averages, breaks of the 10-week moving average, breaks of the 200-day moving average as your safety valve in which to lock in gains and avoid a potential further decline. And if you sell too prematurely and the stock starts, bottoming out, forming a new base, breaking out again, you can always buy it back. That's one of the amazing features of the stock market and the public trading market. That's one of the powers we have as individual investors. So right now, when you look at DQ, DACO is really, really struggling. Had this short-term move, just like a lot of Chinese stocks did, after the Chinese government announced a pledge to re-stimulate its economy. But since then, it's really not done very well. Next stock is HIMX, another Taiwanese company in LCD displays. Don't know much about this company. It is a small cap, just under 2 billion. It is moving in the right direction. 97 relative strength line, supported the 50-day, the 3-month, and the 6-month relative strength ratings on market surge are very, very strong. And right now, if I look more closely at this chart, first of all, you can see that there are risks that can happen. Look at that big drop. Nonetheless, it's formed what I see to be kind of like a double bottom like pattern, and therefore maybe 11.8 could become a new buy point. Another way to look at it is that the stock has done well, even despite these gyrations. It's done really well since bottoming out, and it has continued to form higher lows, and therefore, bounces off the 50-day moving average could be an entry point, but just you want to make sure to cut your losses short if the rebound off the 50-day line doesn't work. Very, very good estimates going forward for next year. They've had, this is a cyclical company in tech, in my mind, because you can see that after COVID, it had a big burst in earnings, and then really has been failed to continue to grow that earnings ever since. Sales growth is not very strong, so I would much prefer to find a stock that has really strong earnings and sales growth, has a product that is really, really hot, innovative, taking market share within its market. Not sure whether Himax really fits any of those categories there. Snap-on is in the tool space. This has been a steady winner since it broke out here, as you can see. There's a cup with long handle. You could argue that this was kind of a base within the cup with handle as well. So anyway, there was a resistance level here at 289, and it broke through it, made almost an 80-point move, which was really, really good. That was more than 25%. Since then, it's now pulled back and digested those gains, and we have what you might call as a longer consolidation and a flat base, which is no more than a 15% decline from high to low, forming next to what was a failed cup with handle breakout. So I think if the stock rebounds back above the 50-day moving average here, which is currently at 342.62, and then keeps rallying, then that's a really good positive. What I see here too is that the relative strength line, which is in green, this is a line that's plotting a daily performance of a stock versus the S&P 500. On market surge, you can change the S&P 500 to another index if you like, or another stock. So you don't always have to compare a stock's relative strength to the S&P 500. If you want to compare, for instance, a mid cap with the S&P 400 or a small cap with the Russell, you can also do that as well. But in any case, I think this is a healthy correction after a very nice move here. This is not a fast-growing stock, but probably an area that had been kind of underperforming the techs over a while. You can see that this is the actual building hand tools market industry group, and as a group, the group has not hit all-time highs since May of 2021. So, not sure, what's the potential upside here, but you can see at least in the recent months, building hand tools, which is G3548 in market surge, is showing much better action. Here's the monthly chart of SNA. Clearly, you can see that even though the hand tools industry group has not performed well, Snap-on has been better, especially over for a patient investor. And I do like the fact that this is a dividend pair with an annualized yield of 2.5%. When I look at dividend stocks, I also look at the cash flows of a company. You can see that last year in 2024, cash flow on an operating basis was $21.47, and that was even higher than the earnings per share of $19.19. You would expect that cash flow on an operating basis to be higher than the earnings because earnings takes out taxes. And there also might be some other non-cash items. What's really important to know is that, a lot of the best companies always delivered on big operating cash flow. Bill O'Neill had a rule, and he wrote that in his book, How to Make Money in Stocks, that particularly among high growth tech companies, he preferred those companies that showed operating cash flow rising at least 20% faster or 20% higher than earnings per share for the same year. So this is an annual figure. Let's take a look at NVIDIA as an example. So in fiscal 2025, which just ended just this January, NVIDIA earned $2.99 a share, has 24 billion shares. Its cash flow was a little bit better, $3.11. Let's look at Google. Even better operating cash flow versus earnings. Last year earned $7.79 a share. Operating cash flow was $9.20. Okay, and the last stock within the list that I scribbled during the break was 3M. Big weekly decline, 5% after a huge 7% gain. Heavy volume on both weekly bars. I like the fact that when the stock pulled back here after initial breakout from this base here at 141, I like the fact that the volume was quiet. It quieted down. That signifies to me that the enthusiasm among market participants to sell was less than the enthusiasm among bulls to buy. Now, this past week was tough. If we look at the S&P 500, right? S&P 500 was down hard, 3.1%, testing the 40-week moving average. NASDAQ down 3.4%, below that 40-week moving average for the first time since October 2023. So if we go back to 3M, no wonder it also had real wild volatility in an outside week in which the highs and the lows were higher and lower than the highs and the lows of the prior week. It was very volatile action. Nonetheless, what I see bullish in 3M is one, you see the stock is getting support right where it should. After a breakout, you want the stock to bounce nicely like a tennis ball off the 10-week line and not get crushed below the 10-week line like it was during these hibernation years for 3M stock. You see how the 40-week moving average was falling, the 10-week line you can barely see, but it's falling. It's completely changed in character. The 40-week moving average is rising. The 10-week moving average has generally provided support, and it certainly found support here. So as I mentioned, that when you have a stock that breaks out, has a nice little move, you're making money in a stock, the stock is above your buy point, and then you have a normal pullback to the 10-week moving average. During that first or second pullback to a 10-week line, if it bounces like a tennis ball, you can actually add some shares to your winning position or even start a new position there. But the caveat right now is that the market is in a correction and that stocks are at more risk of falling than rising. Therefore, I would be a little more cautious here in terms of adding to shares. Maybe keep an eye on how that's performing over the next couple days. So that was 15 stocks, and I don't know how much time it took, but I hope those were helpful.
There's 4 more generic questions. Would you like to handle them now?
Sure, let's do it.
So the narrative might be DeepSeek AI has let much of the air out of the high value AI and growth prospects, NVIDIA, et cetera. Tariff turmoil may slow the economy. Government lower spending may slow the economy. Low inflation may hold down stock market rises. Stable interest rates may help economy to stay stable and result growth I'm looking for the question. Tax breaks may help profit stock market valuations higher to be tempered by trade uncertainty. So I'm not certain where the question is in that.
Well, I'm just going to address that first part. I think because it seems like the question is about what is the future for AI stocks, right, Deborah?
Yes.
Yeah. And so absolutely without question, the biggest shock to the market since the fall of 2024 was the DeepSeek news. A lot of stocks in AI and tech land got hammered. That was January 27th. You can see it on your charts of the tech stocks you follow. And since then, the market in general and those stocks are lower than those price levels. So the rethinking and recalibration of those valuations for those stocks has no doubt changed. What I find interesting though is that CEO Jensen Huang of NVIDIA is trying to, at least he's trying his best to put a positive spin on this, saying that the news by DeepSeek is positive because it's going to lead to more demand for high performance chips. And there'll be more people using these chips to make advances, not just in search, which is, large language model based on what DeepSeek has done, but going beyond to other higher levels of artificial intelligence, such as physical intelligence, general intelligence, uh, what ChatGPT, right, and Google and Meta and Apple and now DeepSeek have accomplished is great for certain types of activity. But the question will be, and the market will give us this answer, not you or anybody else, but the market is whether we are truly in just the early innings of a transformation across many industries and the development of a new industry that will drive new products, new demand for services, whether it be in robotics, whether it be in self-driving, whether it's going to be in true what they call agentic or agent AI to help knowledge workers and other workers perform their jobs more efficiently, more creatively, more effectively. And without question, they're going to be winners and losers. Without question, NVIDIA has proven to be a winner, and the numbers and the law of large numbers would tell us that based on market history, that the growth among these huge companies is bound to slow down. I mean, we've already seen that with Apple, for instance. Apple has not come out with a great new product in years. Hit a home run, as we know, with its MacBooks, hit a home run with its iPhones, but did not go into EVs. I've been pounding the table kind of half jokingly for years that, I think the next big product for Apple is a home, the Apple iHome, like where they could build homes and put all of their products in the home so that people truly live inside the Apple ecosystem. We'll see what they do in the future. Services is a big driver of Apple's growth to offset the slowdown in iPhone growth. The point I'm making here is that I am optimistic that companies and entrepreneurs are going to further change our world, the way we live, work, and play. And those companies will be investable and will hopefully, with the use of good information and with charts, be able to capture those future profit opportunities.
How do you think the debt ceiling fight will affect the market?
It's amazing that the debt uh, the debt ceiling has been rising, right? And I guess the question will be whether the debt ceiling will continue to exist, because I think Trump had once been quoted as saying that he wants to get rid of the debt ceiling. Ultimately, I think the answer will be found in both the bond market. That's why I spent some time showing a slide of the 10-year Treasury and the stock market. I think those two markets will dictate the future discussion of the debt ceiling.
Does the IBD market surge tool cover futures like YM, ES, NQ, or is it for equities only?
It's for equities only. There is no /YM/NQ. When I'm hosting IBD Live, I will, and other fellow panelists will talk about the futures by looking at data on Thinkorswim. You can see that data on Yahoo Finance and other platforms, which is great. The only way we would look at pre-market, post-market action of the general market would be like typing in QQQ, and then you can see, and as well as SPY, those heavily traded ETFs, and we'll show the pre-market and post-market or aftermarket prices right next to the regular session prices on the upper right-hand corner of the chart.
Any recommendation on a low-cost free platform for fundamental and technical analysis?
Great question. I'm spoiled because I have, as an employee, free access to Market Search and to investors.com. I think investors.com is a very reasonably priced source for getting ratings on earnings per sales and margins, relative strength. And there's a screener called IBD Stock Screener, which does a great job of highlighting leading companies in those areas. And that people who are more interested, like I am, in getting that big major move in a stock, in the greatest stocks, just using a screener like that, and then a simple charting service of your desire can be the way to go. I think there probably are multiple tools that are free. Earnings Whispers on X gives you some information about earnings estimates. Zacks and Yahoo Finance, I think, do a good job of showing you earnings and revenue estimates. And then, for sure, if there are like only a handful of companies that you're really interested in, I truly highly suggest that you get familiar with the SEC filings using the SEC Search Edgar database. That's completely free. And every public company traded here in the US is required to file a quarterly and annual report, and you really can glean a ton of information about the company's strengths and weaknesses, risks, and fundamental information.
Should a drop to the 200-day moving average be an automatic sell, or is that too late? Many stocks and ETFs are already there.
Excellent question. It's not an automatic sell signal if you have a long-term big capital gain, because oftentimes a lot of stocks that are in a longer-term uptrend will just pull back, if you will, or correct to that 200-day moving average. If you are talking about a security that you recently bought and it's fallen 7%, no matter where it is on the chart, we highly recommend you sell and preserve the remaining capital so that that 7% loss turns into a much bigger loss in which it might be testing the 200-day. But in a serious bear market, and we don't know, none of us know whether we are at the precipice of a bear market, which means a 20% decline, which means that the S&P could fall another 13%. That, I've seen a lot of stocks and indexes test that 200-day moving average and maybe show some support, but then fall further. And the 200-day does not act as a floor of support, but as a trap door. A great example is one during the Black Monday crash of '87. A colleague of mine, Mike Webster, who's also on the show, he's our IBD senior market strategist. He used to work as a portfolio manager for O'Neill. On a recent show, he asked the host of our main host of the show, Ali Coram, to go back in time and show the chart of the Dow in '87 and before the great Black Monday crash, in which the Dow fell 22% or so. The Dow was trying to hold on to that 200-day moving average, and the 200-day moving average, if I remember correctly, was actually rising at the time. At that time, it looked like there was support, but then the support failed.
What are the green and or red arrows in the bottom of the annual EPS earnings table, 2025, 2026 estimates. They don't always match the percent change.
That's a great question. Let me reshare my screen. I'm going to show 3M. So there has been no changes. Let's see if maybe Apple has some changes. Yeah. So this is a good example of how earnings are expected to rise from the prior year, but the red downward pointing caret refers to a downward revision in the consensus estimate. So if you have a green upward pointing caret, that means the overall estimate among the analysts surveyed has risen from a prior number. That's all it is.
Those are the general questions. I think there's another 8 stocks that have probably come in. Do you want to handle those or end the meeting?
I'm happy to take on 8 more. I mean, are there still people listening and on the call?
There's 70 out there.
Oh, really?
Yeah.
Is that kind of your average attendance?
It varies. 70 is reasonably good. There are times when we
Okay.
go to 120, 150, but not.
Wow. Okay. Well, that's good. That's good. Well, if we still have 70 people tuning in and not bored out of their mind, not ready to throw lemons and tomatoes at me, then yeah. Sure,
No,
we can go through 8 more, and
oh,
you can just read them off to me. And first of all, before we end, I just want to just say, uh, you know, please do not hesitate to contact me, email me, david.chung@investors.com. I'm here as a fellow proud member of the AAII, and just so happy to be involved with a lot of other events like this one today, and would appreciate any feedback, positive, negative suggestions, open to it all. So really appreciate your time, everyone. So go ahead and fire away, Deborah. 8
Costco?
more. Costco.
Costco.
Oh, okay. Yeah, this one shook me out recently, unfortunately, based on the negative response to earnings. And this happens a lot because, earnings is typically a volatile time for the market. I did not expect it to be this volatile, however, and I think maybe it was partially due to the fact that the earnings were below expectations because the company took a bigger hit on foreign exchange. So if they didn't have that biggest hit, the earnings would have actually beat estimates and maybe wouldn't have fallen this much. I think the the 8% drop for the week doesn't at all though damage the long-term bullish view I see in this chart. Uh, if you've held this for years, you've done great. Even if you bought it at the highs of the time, right? So here's the monthly chart. You got a stock that has risen 25-fold from the end of the GFC bear market. Incredible. I mean, kudos to those who have that patience. And I think it's very important to be patient in holding the best companies. This is clearly still a great company. Probably is going to need some time to digest these gains. You can see it went from 600, a resistance here around 600 to up to 1,000. So for this stock, you can tell that the slope of this gain is pretty comparable to some of the faster runs it's had. Weekly chart shows that the growth is expected to continue, so that's a positive as well.
Netflix?
Netflix used to be part of a leaderboard model portfolio product that I'm a co-manager of. Here again, when the market is down hard, it's typical to see the growth stock leaders down even more. There's a good opportunity to note that when you have a correction in the market, you can expect the biggest winners, the best growth stocks to fall 1.5 to 2.5 times the correction in the S&P or the NASDAQ. So if the NASDAQ falls 10%, it has actually, right? The NASDAQ has fallen, I believe, 12% off its high. It is not at all abnormal, very common and natural for a top stock to fall 18% to 2.5 to 12% decline, which would be 30%. So, an 18% to 25% or 30% drop falls within the range of a base building phase. If we look at this base, this was a 29% drop. This base was 13%. That was even less, but this was built after a very nice long run up. So it's really kind of not surprising when you have a lot of bases built, the risk that a breakout fails unfortunately goes up. Not to say that the stock will automatically come down to the 40-week line. It could be the bottom. We don't know. We'll have to just keep watching and get a sense of the ongoing balance between supply and demand.
You apply the 7% loss rule to a stock with large gains, i.e., trailing stop loss?
Well, that's not one of our main rules. We like to use the rule of breaking through the 10-week moving average as a time to consider taking some gains, especially when you do have a big gain, because the stock could fall 7% and still be in its uptrend. Therefore, we generally don't advise using that trailing stop loss rule. But each of us is different and unique, and if using a 7% loss for the week as a way to trigger some profit taking and it works for you, that's great, because maybe a stock, when it's pulling back in the midst of a nice run, is only pulling back 2, 3, 4, 5%, but once it falls 7%, that's abnormal and out of range. So I just want to reiterate that this trailing stop loss rule is not part of our general rules. We're looking for big drops in heavy volume, undercutting the 10-week line, undercutting the 50-day moving average. At the same time, looking for climactic action like we saw in SMCI. See this stock had nice runs, pulled back, nice run, pull back, nice run, big move, and then a pullback, and then this was the final climactic run because it went from 30 to 100 in just 7 weeks or so. I mean, that is a climax action. That's another sell signal that we would like to look for among the biggest winners.
KLAC?
Sure. KLAC is part of a special list we have in investors.com called the IBD long-term leaders. Let me share another page to show where those long-term leaders are. As you can see on this chart, KLAC is in a base. And here we go, long-term leaders. And it's had a nice move since its 2022 bottom, since its breakout from this cup, since the breakout from space. So this is a much longer base. And so I'm familiar with this company, definitely a leader in the chip equipment space. And I will now share another page here. This is the actual list of the IBD long-term leaders. This is located in the stock list section, which I'll show. But you see KLA right here is part of 12 stocks that are in the long-term leaders portfolio. Great EPS rating. EPS growth has slowed over the past 3 years, but it has stable earnings. The lower the stability factor on a scale of 0 to 99, the better. So we don't look at any stocks that have a stability factor of 20 or higher. So that's really, really good, especially for a chip equipment company. You can see here that the earnings are expected to rise 33% this year. That's fantastic. I want to point out that the fiscal year actually ends in June, so we only have 2 more quarters to go. In fiscal 2026, which starts in July of this year and ends in June 30th of next year, around that time, earnings are expected to slow down to a 3% increase. Great ROE, return on equity, another form of profitability. However, it has a high level debt level, so high debt levels can influence return on equity as well. To find this, yeah, so I recently updated this story, talked about cadence and SPS Commerce leaving the exit list, leaving the watch list. But basically, within investors.com, you have the stock lists, and we have all these stock lists. And right here is the long-term leaders. That's where you find it, underneath the big cap 20 and just above IPO leaders. Let's go back to the chart. You can see that this is a very large company, 94 billion market cap. So this one is this is a serious big company, Milpitas. So in your backyard, everybody. Number of funds has fallen sharply here. Let's see if it continues to rise. Majority of the stock is owned by funds. Overall, though, very impressive fundamentals for a notoriously cyclical industry.
AXON?
Exxon is the Taser company.
Oh,
Very, very great stock. Now in a base. This breakout failed. This was a huge, huge reaction right before earnings. In fact, I'm trying to remember what was the specific news here. But it might have been related to fear of budget cuts that could impact federal agencies and the ripple effect it could have on state and local governments that use the taser. Amazing technology. They have a great mission to reduce the amount of police-related homicides. I think that's a noble goal. And the company has done an amazing job of creating a ecosystem like Apple surrounding its taser to fuel sales and earnings. So you can see 7 years ago, it earned 74 cents a share, and in 2024, it earned $5.94. So that's a sevenfold, almost a ninefold move, which is really impressive in terms of earnings and fundamentals. But right now, you can see that, as we've talked a lot about during this session, we have potential tests of that 40-week moving average or that 200-day moving average, which is here in black line here too.
BRKB?
Well, that's been an amazing hold for investors. Really incredible testament to Warren Buffett's business acumen and selection of companies to fill his portfolio. It'd be very interesting to see if and when he steps down, how his protege Greg Abel will do.
IBM?
IBM has been one of the best blue chips lately. You can see that when it broke a downtrend here. This has been a long downtrend. The stock's been in the wilderness for a long time. Now it's found itself in leadership territory. Really, really impressive move here. And part of it is because I think maybe the management has been more successful in convincing Wall Street that now they're going to be growing sales better than before, and earnings growth is coming back. Although, as you can see, these earnings are not sensational earnings. This is still a big company with almost $250 billion market cap. So keep your expectations attuned to that. Basically, you got a flat base on top of another set of bases here, which is positive. A lot of great stocks emerge out of these base on top of base patterns. So for now, from an IBD point of view, a breakout would mean buying the stock once it surpassed 265.72. But given that the stock has had a nice trajectory higher, assuming that this trend doesn't break, pullbacks to the 10-week line and even possibly the 40-week line could be also an alternative buy opportunity.
I believe you already covered CAVA, didn't you?
Kava? No, I didn't. This
Oh,
was a stock that we covered a lot. Definitely correcting huge after a really hot run. So Lynn and Deborah and Celia, have you been to a Kava restaurant?
I think they're in LA, but I haven't seen one in the Bay Area.
Not in the Bay Area. That's good. That's good intel because yeah, they're striving to be the Chipotle of Mediterranean healthy cuisine, and you can see by their earnings and sales growth that it merited this incredible move up. But right now we are in the midst of a very deep correction, 51% off the high. So that's tough because once you've fallen 50%, you need to rally 100% just to get up back near its all-time high here. And that's a lot of work. So even though the stock might eventually get up here, once a stock is rallied 100%, is more prone to more profit taking and some volatile action, which makes the breakout opportunities tougher. Nonetheless, we've seen Tesla, we've seen Nvidia, we've seen Apple and other great stocks, probably Chipotle too, fall 50%, bottom out, build new base, and then even run to even new highs. So I would keep this on a long-term watch list.
CHOP, did you cover that? I didn't see it in my list.
Sorry, which one?
CHOP,
Oh,
SHOP.
Shopify. Okay, Shopify. This one is just disappointing action the last 3 weeks, even though it's had a nice run here. You had a good breakout, obviously a great breakout here on earnings. It was up 24% for the week, then formed a new base, but now it undercut the low of this base. So we'd expect the stock to now just sort of ideally hold 100 and form a new base, then set up a potential breakout.
Len, you had sent me a direct message, and I don't know the stock because I couldn't find a symbol for it.
Duolingo.
Oh, it's misspelled. Okay, Duolingo.
Oh, Duolingo. Okay, Duol. Yeah, this stock has had some nice runs, but it's volatile, very volatile. You can see that after this nice move, for instance, it just really chopped people up here. Found support to the 40-week line in these two cases, formed an array of bases here. This is a tough stock to own, but you know, if you were keep a close eye on it and give it multiple chances, eventually it had this beautiful run. Short term, a double from the double bottom entry of 215.04 to as high as 441. So it more than doubled, but now we are back to kind of its old ways, in my view. This is a very rapid drop. 33% over 3 weeks is unusual. And in fact, it dropped more than 33% from that peak of 441. Yeah, I would say it probably is fallen closer to 45%. So for me, this is not necessarily a buy unless you know, if you think that this is the bottom and you want to use the 40-week line as your entry point, then I would argue a stop loss should be placed here because you don't know whether the stock could fall another 10, 20%. You don't want to get hurt by that.
Those are all the questions I see in chat. Some apparently direct messaged you.
Oh, really? Okay. Give me 1 second. I'm gonna get a little more water here.
Well, some of the stocks you were listing I didn't see in the global chat, so they must have direct messaged you.
Direct message me. Let's see if I see. Well, I'm very thankful for those who enjoy the discussion. I'm seeing that we cover pretty much all of them, except there are a couple more. Tempo stock. I'm not even sure what tempo stock is. I see there's a question on Millie.
Yeah,
Let me,
that
let me,
just came in. That's the only.
yeah, we'll just cover just two more because I think at 11:30 it'd be good time. My stomach's starting to growl.
Okay.
I don't know if this is the one. Millie. Okay, well, let me share my screen real quick. I remember there was a stock called Millicom, but when I type in Millie here, this is what I get. I get a long short equity ETF. I do not know what this does. Chart looks pretty interesting. It's since its debut, it's rallied some. But if you go to a daily chart, you can see that this is not exactly a big run up because of the scaling on the chart. So from 25.63, it's gone up to 28. So, but if this was a new IPO, I'd be definitely interested because it would show there's a lot of underlying demand for the stock after going public.
They updated it to be MELI.
Oh, Mercado Libre, of course, of course. Yeah, this is another stock that unfortunately saw a breakout fizzle quickly. This one seemed to have a lot of promise, right? And if you have a long-term view toward continued growth in e-commerce, then I don't think this is a sell signal here. But if you're trading this stock and you're an active short-term trader, you would have had to cut your loss or at least uh, prevent a round trip of those gains when it came into this gap. This is one thing we didn't talk about, but let me show what a gap is. On this day here, I'm going to get rid of the pattern recognition. On this day here, you can see the stock was up 1.7%. The high of that day was 21.19. And then the earnings came out after the close. They were great earnings. And then the next day, the stock opened in between this range of 22.26 and 23.74. So it produced a bullish or positive gap between the high of the prior day and the low of the next day. This is a bullish gap. But once a stock starts to eat into this gap, is filling in the gap, that is an expectation breaker and a time to be more cautious and perhaps even say sell half of your position or even get out completely, because that's just not the way a new emerging leader should act. Once the stock gaps up, ideally you want to see the stock really hold that gap and just continue to shoot higher and make new highs. But that's not the case what happened. And part of that is the 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 reality of the stock market itself. Most stocks are going to follow the market direction. And given that at the start of our session, we talked about how right now, since March 3rd, we reduced the exposure level recommended for active stock traders from 20 to 40% to 0 to 20%, is really not a surprise that these stocks are really struggling to break out and keep hitting new highs, because it takes a lot of buying and a lot of money and a lot of energy to be able to do something like that. Nonetheless, I think what's going to happen here is that we have now the start perhaps of a new base. Generally, a new base is going to take at least 6 weeks to form for a cup base, 7 weeks for a cup with handle, as the ones I've showed you today, 5 weeks for a flat base. Sometimes, once in a while, though, a stock that's really, really strong will bolt past the prior buy point even before 5 or 6 weeks have passed. If the market is in better shape and other leading stocks are doing well, that is sort of an alternative entry point that could have a high probability of working. But in this point of the market, my guess is that we're going to have a longer digestion phase after these nice moves by Melly, and then if the stock is going to become a real leader, it's going to take more time to make that setup.
Okay. Thank you.
Thanks, Dave.
Thank you.
Great.
Well, I appreciate everyone's great questions. And I don't know if you've ever covered this many stocks in your chapter meetings before, but I had fun. I hope everyone else did.
Well, we enjoyed it, and you covered a lot of territory, and it also gave people an opportunity to really look at investors' business daily as it now is formed and operated. So we appreciate your time and your energy.